Thank you for joining the employee education presentation for Horton Grand Retirement Plan. My name is Chris with Wealthwise Financial, and the following things I'll be going over with you. First, a brief introduction about who Wealthwise Financial Services are, who your record keeper is, what the responsibilities of those two institutions would be, some of your plan highlights, why you should be saving for retirement, what types of contributions you can make into your retirement plan, a high-level review of your investment options within the plan, and then concluding this meeting. So first, who is Wealthwise Financial? We are your retirement plan consultants. Wealthwise Financial Services has been in business for over 20 years, assisting families and business owners towards their financial goals. We are the investment fiduciaries on your plan and provide employer-level support, managing and helping with some oversight on the retirement plan, which includes things like selecting and monitoring your investment options, going over and benchmarking your plan expenses, your fees you're paying for services that your record keeper and administrator are providing. And then we also provide employee level support, which is what this meeting is. Things like employee education, like this webinar, employee guidance, helping employees to decide, things like how much they need to be saving for retirement to reach their goals, to be ready to retire on time, as well as, some guidance on what types of allocations they should be looking at and investing those assets in the plan. Someone else involved in your retirement plan is your plan's record keeper. This is Fidelity Investments. They assist both your employer and you by providing some of the following services. They receive all your payroll contributions and invest those inside your accounts in the investments that you've selected. They provide statements on a quarterly basis. These statements would include things like your investment performance, where your assets are being contributed and held, your account balances, how those account balances have changed and why. They also provide ongoing communications regarding any type of plan level changes, whether it be services provided to you on your plan or even plan provisions, which we'll go over shortly. And they have a network to provide customer support. Customer support can include things like they manage the website where you can view your accounts and see your performance, make exchanges between the investments available within your plan, mobile apps where you can use their tools, 800 lines where you can call and get investment guidance from people that work at Fidelity Investments as well. Next, let's look at some of the highlights on your plan. In order to be eligible to contribute to your plan, you have to be a minimum of 21 years of age and have worked 1 year of service at Horton Grand. So 1 year service usually constitutes about 1,000 hours of service. Your plan does allow loans. So these loans, you can take a maximum of the lesser of either half, 50% of your vested account balance, or $50,000, whichever is less. Your plan also allows rollovers. Rollovers are accepted into this plan, which means if you have employer assets anywhere else, if you have employer assets with a former employer's 401k plan and you want to consolidate your retirement assets, you can roll those assets directly into this plan by direct rollover. Or if you have individual retirement accounts outside of this plan, saved for retirement, that you want to roll into this plan, again, doing a direct rollover in the plan, it keeps you from having, pay any penalties or taxes on those assets if they're moved directly from one qualified plan into this qualified plan. There's no withholding, there's no penalties, and you can consolidate your retirement plan assets in one place. This plan also allows Roth contributions, which are after-tax contributions. So we'll go over that in more detail coming up here shortly. Your plan also has the flexibility for your employer can make a discretionary employer match from time to time when they see fit and that it's viable. As far as getting money out of the plan, once you've contributed to the plan, there's many reasons you are able to withdraw money. First of all, obviously retirement. That's what this plan is for. It's to help you save and grow a nest egg for retirement. Next, permanent disability. If you become disabled, you'll be eligible to take the money out of the plan. Financial hardships. This would be things like to secure your primary residence, to pay medical bills, things like that. Severance from employment. Of course, if you no longer work at Horton Grand, that is a distributable event where you can get assets out of the plan. Now, if you're under the age 59 and a half, things to consider: any assets you take out before 59.5. Not only are you taxed if those are pre-tax assets and earnings, their taxes on your income, there's also a 10% penalty tax on top of that if you're actually receiving those assets before you're older than 59.5. Now, again, a better option might be to consider, if you do separate service, you can usually roll the assets that are in this plan over into your own individual retirement account, or you can roll your assets into your new, if you've changed jobs, you have a new employer that has a retirement plan, you can roll the assets from this plan into that new retirement plan directly to avoid any taxes or penalties. And obviously, if anything happens to you, you want to make sure you have beneficiaries listed on your account, so if something happens to you, the beneficiaries will receive the assets in the plan. So let's look at contributions. For next year, for 2026, employee contributions are limited to $24,500 maximum. In other words, the maximum amount you can defer from your pay to go into the plan annually. For employees that are 50 years and older, there is what's called an additional catch-up provision, which allows an additional $8,000 on top of that, which brings you to a total maximum of $32,500. Now, the Secure Act 2.0 legislation actually provides another, what they call a super catch-up, for individuals that are between the ages of 60 and 63. And that's, instead of the normal over 50 catch-up of 8,000, it actually goes up to 11,250 for 2026. Now, there are a couple requirements beyond just making sure your payroll provider through your employer has set up this, what they call the special catch-up or super catch-up for those 60 to 63. You want to make sure, one, again, you're either age 60, 61, 62, or 63 before December 31st of the calendar year that you plan to use this special catch-up. And generally, you would have to already contribute to the maximum deferral amount of $24,500 in 2026 in order to be eligible to then start taking advantage of this catch-up. Now note, once you turn 64 years of age, you would be required to go back to the normal standard catch-up of $8,000 in 2026. And remember, employees can contribute up to 100% of their earned income, as long as they're, again, not going over their standard contribution limit plus any catch-ups they're eligible for based on age. So let's look at another provision of the Secure Act 2.0. This is a new provision regarding Roth contributions for high earners. The IRS has basically, these rules came about years ago, but they delayed them and they start January 1 of 2026. So that's when the provision kicks in. But how does it work? Well, anybody that made excess of 145,000 in 2025 and is going to make an over 50 catch-up contribution in 2026, all those catch-up contributions must go in on an after-tax basis as a Roth contribution, which again I'll go over in detail here shortly. This actually moves up in 2026 to 150,000. So in 2027, when we look back at your total wages for 2026, if it's over 150,000 and you're over 50, you're making a catch-up. Those catch-up contributions then would have to go in as Roth by regulation. So let's look at considering why you would want to save for retirement in a company or employer-sponsored retirement plan. For one, Social Security may not be enough, and it normally isn't for most people. A study conducted by Senior Citizens League found that buying power of Social Security fell by 36% since just the year 2000 due to inflation. If an individual is 55 years old today and they earn about $75,000 a year and they desire to retire at 65, 10 years basically, they would expect a future benefit of only a little over $2,700 a month or a little over $32,500 annually. That's only 43.4% of their current annual earnings. So again, that would be trying to live on half of the wages you currently make when you're working full-time in retirement. Another reason to save in these retirement plans is because compounding returns can have an exponential impact on your wealth, which we'll go over in detail shortly. Also, those who have ample retirement savings can enjoy the later stages of life instead of struggling and having to cut corners, and they can usually retire on time and not have to work through retirement. Contributing to retirement plans can have tremendous income tax benefits now as well, which we'll also cover. What are some of America's top financial regrets? And this goes to the previous slide of why save retirement. The number one, which over 20% of those surveyed in 2023 said was not saving enough for retirement early. In other words, not starting to save for retirement early enough. The reason for that being is people realize later when they start saving for retirement that the power of compounding interest and compounding earnings and starting early is the most powerful tool you have to achieve your goals of retirement on time and comfortably. If we look at the average 401k balance at age 30, which is approximately $30,000, if you grow that at a rate of about 7% over the next 35 years, that $30,000 due to compounding tax deferred would be worth over $320,000. And again, this is someone that has $30,000 in their account at age 30 and stops contributing. Now, if someone who starts retirement saving at age 30 and also expects to receive the same 7% rate of return till retirement, they would need to contribute over almost $178 a month for the next 35 years just to make up for the person that started saving earlier in their 20s and had built up $30,000 by the time they were 30 in their retirement account. The person that waits to 30 to catch up has to make at least $178 a month contribution for the next 35 years just to catch that other person. Let's look at this in more detail. So taking that same example, let's say someone waits till age 40 and they want to catch up to the person that had $30,000 in their account, save for retirement at age 30 and stop contributing. Someone at age 40 would have to contribute almost $400 a month for the next 35 years to catch up to get to 65, at age 40 to catch up at age 65, they would have to contribute almost $400 a month. If someone waits to 50 to try to catch up to that person that just had $30,000 in their account by age 30, they would have to contribute $1,000 a month till age 65 just to catch up and break even with the person that only had put away $30,000 by the time they were age 30. So again, that power of compounding time is your biggest advantage. Even if you can only do a little bit of money starting, the earlier you start, the better. Even if it's only $50 a pay, $100 a month, whatever it might be, the earlier you can start, that compounding snowballs. So every year you're earning interest and earnings on your earnings, and as that snowball builds, time is your biggest advocate. This is another way to look at that compounding. This took the average returns in the stock market from 1957 through 2021, which the S&P 500, the largest 500 companies traded on the stock exchange in the United States, averaged an annual return of around 11.8% over that same time period. So let's look at what would happen if you just put away $100 a month. If you're paid twice a month, that's $50 a pay. After 10 years, you should have around almost $23,000. After 20 years of doing $100 a month, almost $100,000. After 30 years, $340,000. After 40 years, $1.13 million by just simply starting early and doing $100 a month, starting early in your career. Now let's look at the different types of contributions. You have both pre-tax and Roth, or what are considered after-tax contributions. Let's look how that affects your pay, and then we'll look at the differences with the benefits of doing pre-tax and after-tax contributions. So if your gross pay is $2,000 and your tax bracket, you're being withheld about 30% due to taxes, your net take-home pay would obviously be $1,400. Now what happens though when you decide I'm going to contribute 6% pre-tax to my 401k plan? Well, your pre-tax contribution comes out before taxes, so that would actually lower your taxes that they're collecting down to $564 instead of the $600, which means your net pay does not go down dollar for dollar. Your net pay only goes down to $1,316, even though you invest $120 from that paycheck. What does that mean? It means you get to keep more of your hard-earned money for yourself and pay less in taxes by doing pre-tax contributions. Now you will be taxed on those pre-tax contributions, any earnings in retirement when you take the money out of your plan. Let's look at what happens when you do after-tax contributions. After-tax contributions, you'll see in the next section, 6% Roth contribution. You're going to pay your taxes same as not making a contribution, $600 on your $2,000. Your Roth contribution of $120 would go into the plan, and your net pay would go down to $1,280. Now, that is a dollar for dollar deduction, whereas a pre-tax deduction is not a dollar for deduction of what your take-home pay is. But there's many reasons to have after-tax contributions and pre-tax contributions. Let's go through that on the next slide. So why contribute to your Roth 401k? Well, in this example, we looked at when would it not matter whether you did a pre-tax or an after-tax contribution. And in this example, we're looking at contributing $100 either on a pre-tax basis or an after-tax basis, growing that for 35 years at 6% annually. How much would you have to spend when you didn't pull the money out in retirement? Well, on a pre-tax basis, if your taxes are 30%, you're in a 30% tax bracket when you put the money in, and your taxes are the same in retirement when you take the money out, there's no difference. You would have $538.03 to spend whether you did pre-tax or after-tax contributions. Now, how many people's tax brackets stay the same? That, in other words, during your earnings years when you're working full-time, are you going to be in the same tax bracket as when you retire and possibly have less earnings per year? Your tax bracket could go down. Or, again, we can't predict what's going to happen with future tax brackets. It seems, because Congress has to vote on what the tax brackets are from time to time, it seems that over the long haul, tax brackets seem to always go up and rarely go down, but sometimes they do go down. But we don't know. We can't predict the future. But if all things stay the same and your income was the same in retirement as it is before retirement, doing pre-tax or Roth wouldn't really make much difference. But there are some other advantages, which we'll go over in the next slide with Roth contributions. Let's look at a different example. Let's look at what would happen if the taxes go up in retirement instead of down. Well, then a pre-tax contribution being taxed at a higher bracket when you take it out because taxes have gone up, you would only net $461 in that example to spend. Whereas if you would have done an after-tax contribution as a Roth contribution, you would then still end up with the $538 to spend using the prior example. Now, a couple things to consider. If you're, pre-tax contributions and there's earnings on pre-tax, there are things called required minimum distributions that say when you hit a certain age, like 73, on an annual basis, you have to take out a certain amount and be taxed on it. They want to get their taxes. The government wants to get taxes. However, on Roth after-tax contributions, they do not have required minimum distributions that you have to take out each year. That money can stay in there. You can decide how much you want to take out, and it's not taxed. It gives you flexibility for many things in retirement. It gives you flexibility. Let's say you're taking out pre-tax dollars. That's considered ordinary income in the year that you take it out. Let's say you need to take out large amounts for certain things, and that pushes you into a higher tax bracket. Well, if you had a bucket of Roth money as well, you could take out just enough pre-tax and the rest take out as Roth so you don't get pushed up into the next tax bracket to start paying more taxes. You could use the Roth contributions to take out money so your income isn't so high that it reduces your actual Social Security benefits. Roth, because you don't have to take out minimum required distributions after a certain age, can be held in there growing tax-free, and then if something happens to your beneficiaries, you'll be able to inherit and take that money out without paying any taxes. So there are a multitude of different ways to look at Roth after-tax contributions and pre-tax contributions. We suggest talking to somebody that can give you some investment guidance as to your individual situation, whether it's better to do pre-tax or Roth, or maybe a combination of both. Now let's look at the 3 stages of retirement. When we think of retirement, you have an accumulation stage. This is when you start working and saving for retirement. That's usually between the ages of 23 to 45. You're a younger investor. You have a longer time horizon. Remember, compounding in time is the biggest thing on your side. It also, if you have a very long, what we call a time horizon until you're going to start drawing down these funds and taking money out of the account, it allows you to be slightly more aggressive, and you can take on a little more risks because you can wait out any periods in the market where there might be volatility, where things are going down. They over time normally recover, and we'll show you some of that on the next slide. The next stage would be your preparation stage. This is from 45 to 65 when people really start focusing and thinking about retirement and when they can retire and how much they need to have saved. This is usually also your peak earning years. This is when you've built up experience over the previous 10 to 20 years when you've been working. So now you're getting paid more, you've been promoted, you've changed jobs a couple of times and moved up. So this is really where you're going to be having higher income levels and able to contribute the most towards retirement. And then lastly, the distribution stage. This is when you've retired and now you're living off these retirement assets or supplementing your Social Security income, and you're drawing down these retirement assets. So let's look at the stock market. This looks at the S&P 500 from 1980 to 2025, and it looks at the volatility in the largest 500 companies publicly traded in the United States, which is the S&P 500 index. You'll see the gray lines are above the zero of all positive returns, and you'll see the red dots and all the negative returns. And this is looking at inter-year drops in the market. So you'll see on average, the market drops sometimes and can be negative as far as an average of 14%. But 34 out of these 45 years, even when the market had a drop, it finished in positive territory, which means by the end of the year, even though it might have been negative during a period during the year, it finished with a positive return for investors. Another thing to think about, again, the longer the time you have, the more aggressive you can be with your investment selections, simply because if there are down years in the market, like you see here around 2001, 2002, 2003, you'll see that there was negative returns in those 3 consecutive years. If you were investing money and you were about to retire and you had to start drawing money out right after those 3 years, you wouldn't have recovered. But someone that has, a 10 to 20 year period, even if there's 3 down years in the market, if you look on average over time, the market averages a positive return, but you have to have the time to wait out the down years when there's negative returns so you can return to positive returns to recoup and then still average a positive return overall on your investments. Let's look at the types of investments. Your plan has both stock funds, bond funds, and capital preservation funds, as well as target date funds available for you to choose. Now, for those people that want to pick their own investments, again, your stock funds are going to be the most volatile equity funds. These are for long-term growth, but these include market risk and market volatility, and they can move a lot on a daily, weekly, yearly basis. Your bond funds are slightly less volatile. They're going to be more susceptible, though, to interest rate changes. So if interest rates go up, the value of bonds goes down. If interest rates go down, the value of bonds goes up. Bond funds pay an interest rate, unlike the stock where you also have fluctuations in the value of the stock and they might pay some dividends. And then capital preservation means things like your stable value accounts, your money markets, where its goal is to protect your principal and pay a very small interest rate. But there you have to worry about inflation, the risk of inflation, because if inflation is growing faster than your interest rate, you're actually losing purchasing power on those dollars stuck in those capital preservation funds. So for those people that don't want to pick and choose, you can always get guidance again from Fidelity or from us of how to allocate your assets in these different options based on your time horizon and risk tolerance. But a nice thing is that if you enroll in the plan and you don't select any investment options, your plan has set up what's called a qualified default investment alternative. It means if you don't pick any investments, they will deposit your contributions into a target date fund based on the normal retirement age. Now, these target date funds are simplified one-stop shops, a lot of people call them, because even though your money is only going in the one fund, it's being immediately inside that one fund. It holds a bunch of different funds, both stocks, bonds, capital preservation inside that one fund, and it diversifies your assets for you. And it also rolls through what's called a glide path. It rolls things more conservative and adjusts those investment percentages in the different asset classes so that as you get older, it protects more of your nest egg you built up and gets more and more conservative as you get towards the age when you're going to start drawing down and living off those retirement assets. Again, so it does a lot of things automatically for you. It diversifies. It gets more conservative as you get older and starts to get more conservative, protect your assets against volatility as you get older, closer to retirement when you'll start drawing down. Let's look at a typical glide path on a target date fund. You'll see the dark red is your your volatile stocks, your growth funds, growth stocks. And then your orange is slightly less aggressive. Those would be growth and income funds. Those are stocks that pay dividends, minimize the volatility on the stock price a little bit. You'll see equity, income, or balanced funds in the middle. These are made up of both bonds and stocks, and you'll see the bond funds. And you'll see as you get older, closer to retirement, the bond funds go up. The percentage that's invested in bond funds gets higher and higher, and the percentage of the red, the most volatile stocks, gets lower and lower to almost none at retirement. And again, this is going to happen automatically without you having to do anything. These things are going to be constantly rebalancing and moving more conservative as you get older and older towards retirement. So again, diversification is important. If you're in a target date, you're automatically diversified amongst stocks, bonds, capital preservation. All of these asset classes are available in your retirement plan. You have everything from large company growth stocks to large company value stocks, which tend to be slightly less volatile. Think of buying stocks that we are considered at a discount, trading below what their true market value should be. You have mid-cap stocks, which are medium-sized companies, small-cap stocks, smaller-sized companies, international stocks, not companies based in the United States, emerging market stocks. And then bonds, you can have everything from government bonds to corporate bonds, inflation-protected bonds, high-yield bonds or junk bonds, things like that. Again, we suggest that you reach out to an advisor to help you get some guidance, either Fidelity or yourselves, if you're looking at trying to pick your own investments. Or again, if you do not pick your own investments, you'll be defaulted into the target date fund. What happens if you change jobs and leave employment with your assets in your plan? Well, you can leave the money in the plan here as long as your balance is over $7,000. You can leave the money in there. It'll stay invested. It'll keep growing tax deferred until you take it out in retirement. Or you can move your retirement assets to another employer-sponsored plan. If you get a new job and they have a 401k plan, you can roll those assets directly from this plan into that plan. Or you can even roll the assets out of the plan here into your own individual retirement account or IRA. Now, you could, once you separate service, technically as a distributable event, you could take a lump sum distribution. However, if you're under 59.5, not only are you taxed on that distribution as if it's ordinary income at whatever tax bracket you end up in, you also would be hit with a 10% penalty tax on top of your normal income tax if you're under 59.5. Now, distributions from pre-tax contribution sources and employer contributions are treated as ordinary income, like I said, and they'd be subject to not just federal but also state income taxes if they're state income tax in the state you reside. So other things to think about before savings for retirement is one, having an emergency fund for emergencies that come up, things like car repairs or house repairs, things that come up. It's good to have 3 to 6 months saved for things, emergencies that come up like that. Make sure you always, if you do start contributing to the 401k, make sure you always set up a beneficiary in case something happens to you. If something happens to you, you want to make sure that your spouse or your children, whoever you have as your beneficiary, is able to receive those funds from the retirement plan. Establish long-term savings goals. Again, reach out to Fidelity or ourselves. Get some guidance on how much you should be saving and where you should be investing that money to hit your retirement goals. Now, a lot of research has been done on this, and it seems like the secret sauce is somewhere around 15%. Seems to be what works very well for people. If they're saving 15% of their income through their employment years, when they get time to retirement, usually that leads to being a successful, on-time, and comfortable retirement if you're able to save somewhere around 15% of your current income. And then select investments that are appropriate for your risk tolerance and your time horizon. Again, the shorter your time horizon, the less volatile and less risk you're able to deal with, because you don't have time to recover if there are a few bad years. And the longer your time horizon, the more risk the more flexibility you have to take more risk. But again, your risk tolerance might be very limited. If you don't like volatility, you might end up in, being in bond funds and capital preservation because you just want to get a small amount of interest. You don't want to see too much volatility. Or if you're very comfortable with volatility and you don't really look at it, you don't care if it goes up and down on a daily basis, maybe you're in stocks, maybe because you're younger, you know you have a long time before you plan to retire. Again, that comes down to personal preference on your risk tolerance as well as what your age is currently as you go about investing in your plan. So once again, thank you for attending this high-level employee education. Feel free to contact us if you need any type of help trying to look for tools and how much you should be saving for retirement to meet your goals, what type of asset allocation or guidance you might need to choose investments and things like that. And with that, I will thank you for attending. And again, feel free to reach out and contact us if you have any additional questions based